Oh my God.
Studio.
I
Okay,
think
now it
we're
says, are you guys seeing that it's recording right now?
I think we're live.
Yeah, we are
We're
live.
live. We're
That's what that
live.
says. You're the host. I don't know what it says on your side. On my side, it says we're recording.
Yeah, it
It
says
wouldn't
we're
let me.
recording on my side as well. All right, this has been
All
crazy. I don't, you know
right,
what? In the words of Bill O'Reilly, we'll do it live.
that's right. Are we? So
Great
you're
quote to get us started.
That's
That's
right.
that's right. Okay, well, technical difficulties out of the way. Um, Jose, thanks for joining us, man.
Thanks for inviting me.
So today I'm joined with Dalton Cole, my co-founder at Digital Opportunities Group. I am Philip Moran, CEO and co-founder at Digital Opportunities Group, and we're joined today with Jose from Tungsten. Jose, you've, in my opinion, kind of become the man when it comes to custody, at least describing some of these concepts that are can be like pretty complicated when it comes to institutional custody in crypto. But I'm going to toss it over to you, and I just love for you to give your background um, and the background on Tungsten as well.
Yes, thank you, Phil, and thank you for the invite. And very happy to be here. So a little bit about myself. Just my background is entirely technical, and for better or worse, I jumped into the crypto train roughly 6, 7 years ago. Not early enough,
Hmm.
I will say, but at least good enough to get a good taste of the multiple things. And I took most of my knowledge around fintech for the past 10, 12 years, around multiple startups. And when I got into crypto, I was lucky enough to be part of multiple projects that involve, your traditional 2018 ICO, your startup fundraising with a token generation event, and so on and so forth. And what I realized while engaging with all these very early startups that were dabbling into the world of crypto is that none of them had a proper treasury management solution. Yes, all of them had in one way or form engaged with multi-sig and other additional traditional solutions for your your general business needs. However, it was not really a proper custodial backup, right? So to give an example, right, a lot of these companies that didn't necessarily have a disaster recovery strategy or a business continuity plan, right? We only had the executives of the firm, swapping or doing what I call the nano ledger dance. And for some amount of time and some amount of money, that made sense, but it just really felt odd. Then when I picked that issue, I jumped quickly into kind of like a more, okay, let's how do institutions and then the institutional side of crypto custody. And I joined as a director at one of the first, if not the first, Swiss crypto banking organization in Switzerland. And there I really fell in love with the concept of digital custody. I really focused entirely on what does it take to secure over 1 billion value of US dollars in crypto assets. And I identified a major opportunity on just this particular area. I then got a call from the Middle East, and at that point of time, I was pretty much ready to pack my things and go back to Mexico. If I'm very honest with you, where I'm originally from. However, I figured it out that the Middle East had it was such a blue-green market in terms of the capabilities that it was still offering, and yet had such an advanced regulatory framework around crypto, which is one of the major drawbacks. And then I head over to pretty much let Tungsten. And Tungsten is nothing more than a unconflicted, regulated custodian focusing on the opportunities that come from the challenges or geopolitical risk across digital custody. So we're based in the UAE, we're registered in Abu Dhabi, where our headquarters are, where we operate all our digital assets, where we book our assets, where we have all our private keys. And that offers a lot of flexibility for some of the local players and international players that want to expand into the region or pretty much just distribute the risk. And yeah, that's pretty much me and Tungsten.
Nice. So I think like for our listeners' sake, can you kind of quickly tell us what distinguishes like the model at Tungsten from more general well, I guess like saying generally what the custody models in crypto, but it's like I think that's a pretty, it still is a pretty like not fragmented, but there's a lot of different implementations, right, of like different custody models. So I guess could you like give us like just a little more detail on how you guys implement custody at Tungsten?
Sure. Definitely. Tungsten, and I think you brought a nice point, which is the custody models, right? So we are very close. What, for instance, in the US will be considered as a qualified custodian. So we have what is understood as full control or full access of our clients' assets. So our clients, and which usually range from institutions, foundations, crypto miners, hedge funds, high net worth individuals, they open an account with us. We handle all the key management capabilities and all the required crypto expertise and infrastructure to run or to take on a crypto position. And then we provide them with a wallet and all the required services to organize and proceed coordinating a crypto treasury, for instance, right? So, for instance, for an organization, usually what it means having full control is that we're providing governance capabilities. That effectively means that if you want to move assets rather than having a one person to be able to take a decision, you have multiple layers of authorization, approval that range from wallet creation to taking deposits to, of course, withdrawing assets. If you think, let's say, a foundation that wants to be able to operate their treasury through Tungsten, they can open an account. They can take positions both on their token and to multiple assets underlying their treasury. They can engage and also operate in multiple tokens and blockchains. And they know that no asset will move outside of those wallet ecosystem without a proper approval, without a proper governance. Their assets are also insured through our species insurance capabilities. We offer up to 50 million in species insurance. We have even 150 million through a tech provider as well. We are offering, multiple disaster recovery, so they know that if something happens to us, there's a way that they can recover their assets through our regulatory framework, which is supervised, as I mentioned, by the Abu Dhabi global market. They know that we need to have a particular capital reserve, so we're not going to disappear tomorrow, right? So this is the benefit of this particular heavy custodian control model in comparison to, for instance, third party or hybrid models or self custody, where some of the components that I've just described are put in the burden of the client or the actual user.
Don, did you have something? I saw you going to unmute there.
No, no, no. I had just unmuted in case I got something. Yeah.
In case it comes up.
Yeah.
So one of the things that we've come across is that this definition of full control. I actually find this definition of full control to be kind of like it's actually like challenging to navigate this definition. So like I'll tell you why. So like in the United States, there was this series of regulations, or well, I guess call it regulations or call it like regulatory guidelines. I don't know. Ask your lawyer exactly what it should be called. A license. The SPBD, the special purpose broker dealer set of regulations that has been put in place basically for like brokers of crypto assets within the United States and how they can, like an actual set of guidelines. This has existed for like 4 years now. And one of the guidelines within that set of regs is that the SPBD should maintain full control of assets. I personally, when I saw that, I thought like, oh wow, that's kind of interesting that the SEC would say this, that a broker dealer should maintain full control of assets. I like because kind of everywhere else you would rely on a third party to do custody, right?
Right.
And not only that, but I actually personally think that, and this is my personal opinion, so I would love to get you to weigh in, but I personally think that the definition of full control in a regulatory context like really has to be fleshed out and made very explicit what that means, because in crypto it's like we have loads of the multi-party computation
Yes.
people out there. There's loads of them, right? And I guess just for listeners, multi-party computation, this is where you have say you could have the user, so like a fund manager or whatever, it could even be a bank, and then you have the custody provider, and they sort of the custody providers essentially providing software where both entities can participate in managing the key shares which are required for custodying assets. So there's not like a single entity that really holds like full control, if you will. So yeah. Anyway, I would love to just kind of get your thoughts on that.
Yes. Thank you, Phil. This is a great question, right? And I will divide it in two, right? So the first one is what what should it mean full control, and how the regulatory landscape defines and the challenges that come from that. And the second part is how, let's say, virtual asset service providers, VASPs, as they call it in many places, or CASPs, I think, as they call in Europe, for instance, they should approach these sort of guidelines, right? So the first one, and you brought, I mean, you brought a good point regarding broker rights, but even I think the SEC recently did an update on the custody rule, and again, they use the language that makes you wondering whether solutions where they have this sort of let's call it for the time being hybrid setup, where the underlying cryptographic primitives that operate a particular crypto wallet are distributed into multiple parties, whether that is allowed. If I'm very honest, I think the SEC hasn't really came out, sorry, and said, "Hey, this is the way, this is what we interpret," and that it definitely is a double-edged sword, because it has multiple companies, on the fence. Is like, well, do we need to get a license? Are we a custodian? Are we a tech provider? And then you see other places that they're actually taking advantage of this ambiguity and say, look, we actually are not a custodian. We're gonna only serve as a tech provider, would give only the tools to the client to operate their wallets. However, they keep the cryptographic primitives, right? So that is interesting, and I think that's the first topic that I will say. Regulatory wise, a lot of cleaning needs to be done to make sure that crypto companies across the globe understand what do they engage and to what capacity. And for that, there needs to be a very clear framework and a very clear understanding of how to separate a wallet looks like, and the things to look at that. And I'm going to look at the second section, which is exactly what I meant, which is, well, if you're operating a crypto company, if you're building a crypto solution, what are the things that you need to care to understand how your local or the jurisdiction you're operating is going to evaluate you, or is going to look at you, right? And are you, if you're and remember, I have someone says like, well, if we launch a self custody wallet in the UAE, do we need to register? And they're like, no, that's very unlikely that you need to do that, because at the end of the day, it's you might pose yourself a technical solution. You still need to register a company. You still need to make sure that the license you get for particular offering those services match your goal as a business, but you might not necessarily need to get maybe the equivalent in the US will be like a money transmitter license, right? So I think for that, and for organizations to understand, there's three parts that I think extremely relevant. The first one is what I call means of access. And this ties very well with this topic that you recently mentioned, Phil, about multi-party computation, or MPC, which is when the means of access is like, what is the actual authentication capabilities or authentication device that a client uses to signal a wallet, right? So many custodians and wallet providers over there, they don't give you the actual cryptographic primitives. And if you look at some of the NIST standards, actually they shouldn't, right? They shouldn't really hand over the cryptographic primitives or a private key to a client. They should give you a means of access that provides signal to the underlying wallets, right? So more often than not, what custodians and wallet providers give clients is not the actual keys, but an underlying authentication layer that they can use to move those assets, right? So when you're engaging with a custody solution, you're understanding jurisdiction. It's just like, well, what is it talking about the means of access? Does it mean that the means of access need to be controlled by me, or it being controlled by another person? So one topic, for instance, the non-custodial model, right? A lot of companies say, well, my solution is non-custodial because I never have fully the cryptographic primitives, and I give all the means of access to my end client, right? And they, depending on jurisdiction, that is good enough to say you're a non-custodial solution. However, that might not be the case in other places, right? And the other
So
part is when I
just
yes,
to
sorry, Phil.
sorry, just make sure I understand. So in these jurisdictions where they say that the client needs to have like full, like what does that mean? Like when they make a statement like that, like they need to have like this full, does that mean like the client is holding all the key shares themselves and
Is like
the
full
tech
access, or is
and
it like full and exclusive? Yeah.
Yeah. So what that means is actually they might, let me put it this way, it might mean that the client might not even hold any of the cryptographic primitives, right? So let's talk about France, right? France and the AMF, which is one of the regulatory bodies, they actually have issued a statement when they say, well, French-based CASPs can actually hold all the keys, all the keys. I'm talking about, full private keys, no MPC share, no anything, like all the keys or all the required cryptographic material to sign a transaction. However, if they give enough means of access to their clients to move assets, then they don't need to give any of the cryptographic primitives, right? So it's actually the other way around, right? It means that even if a client doesn't have any of the keys, any of the underlying cryptographic primitive, no MPC shares, no anything, as long as they give you, let's say, a mobile app, a YubiKey, a passkey interface, something that they can verify the client at all points of time. They can move the wallets without interacting necessarily with the end client on a 24/7 basis. Then they are a non-custodian, right? And that's what means of access means, right?
okay. So my takeaway there is that like that can actually vary pretty substantially from jurisdiction to jurisdiction. Exactly what that means, and I mean that's something that we find ourselves. Like going back to the SPBD thing that just mentioned, a couple minutes ago. That's something that we find kind of generally across all these jurisdictions, like globally, is that these just general functionalities and these like general definitions, like there's wide variance, wide variance across jurisdictions, and it makes it quite challenging to to navigate the solutions available. You know, but
Yes.
anyway, I don't want to derail things too much. Like, please, if I'd love for you to go back to your the framework that you use. The means of access, and take us forward from there.
Yes. Thank you, Phil. Yes. So you're totally right, right? And this varies from framework to framework. I'll touch another topic, and I'll also showcase another difference, right? So I mentioned three things, right? So the means of access, it's how do a client can interact with your wallet. So for instance, I'll share a couple examples that are in the wild, right? Fireblocks, a very well-known wallet provider. They give you a Fireblocks application, and you can then move those assets through the Fireblocks application, and that is good enough for you to showcase that is non-custodial, right? So you can say, well, if I can move my assets and Fireblocks as a company through their MPC setup never owns all the entire underlying cryptographic primitive, then they can go to market and say, well, under that particular definition, we are non-custodial, right? However, if you look to a different dimension, and this is the second dimension that I'm presenting, which is the root of trust or the cryptographic primitives that I've been saying or talking about, it might get trickier, right? And what I mean by that is the root of trust usually is the actual cryptographic keys, right? Let's take this example on self-custody, right? So when you do self-custody, let's say you buy a nano ledger, your means of access are the actual nano ledger device, the device that you connect, take, you plug, and the ledger live, for instance, which is the package that nano ledger interacts with. If you don't have meter, for instance, or if you don't have a software that is able to talk with your nano ledger, you don't have the means of access to your crypto. However, your crypto or your actual private keys are generated through the secure element the nano ledger has, which derives through I believe they use a true random number generator, a mnemonic phrase that it's BIP39 compatible, that then you can use outside of a nano ledger, but that that entire root of trust is entirely owned and managed by you, right? So when you talk about purchasing and how self custody says like, well, a self custodian solution, it's only when I own the entire, own your keys and own your crypto. It usually means that you own in its totality the root of trust. So that's why a lot of people, for instance, they look at MPC model where you distribute these cryptographic primitives through multiple parties and say, well, that is not true self custody, because under the pure total root of trust model, my cryptographic primitive to move those assets, I need that third party. So even though it might be a non-custodial model, you know, what it could happen, and let's talk about a Fireblocks example. It could mean that, for instance, if for whatever unknown reason, Fireblocks as a company has a major outage of something happens, you still get access to the keys because they provide you some ways. However, if you want to move an asset and you want to consign a transaction through their MPC model, the transaction might not go through. Why? Because even though it's a non-custodial solution, because they never have the full root of trust, you yourself don't have the full rule of trust yourself, and you cannot move the assets. So if we recap, we're talking about the means of access and the root of trust. So before I jump on the third one, let me know if you have more any other questions, Phil.
Dalton, well, first of all, am I coming through okay right now? Can you
Yeah,
guys
yeah,
hear me?
I can hear you. Yeah,
Yes,
yeah.
sir.
Okay,
Yeah.
perfect. As long as you can hear me. Man, these
So
technical
the
difficulties on my
so
side,
the
these are
difference
annoying.
between
Oh,
custodial and non-custodial is just like a layer of friction, essentially, between access to your assets.
It depends, right? And
Okay.
it depends on the jurisdiction. So this is what I
Right.
meant about, right? So do you remember that I mentioned the means of access in France? It means that a tech provider can have all the keys, but if he gave you the means of access, then are non-custodial. That, for instance, doesn't fly in Hong Kong. In Hong Kong, for instance, they say, well, the root of trust not only needs to be managed by a custodian, it needs to be generated within the country. So an interesting example is that by the HMKA, they say, well, all custodians operating here, they need to generate the keys within this region with hardware security modules operating in this region. So this is a completely different framework, right? They say, I don't
wow.
care about the means of access. I don't care about, how do you give if you give them and user email password to the client, a YubiKey or an actual nano ledger, the only thing that I care is that the root of trust, the cryptographic primitives generating within this region are actually generated here and operated here.
That's so interesting because it's like at the end of the day that almost like doesn't matter, like if it's generated within the country, right? I mean, because it's so easy to take all the the artifacts of the key generation and go wherever, right? It's kind of like the point of crypto in a sense, you know.
Yeah, I'm divided there because I do think there's so in one sense you're right, right? I mean, a private key is a private key, right? But I think when you look at institutional and when you look at major organizations, right? I'm talking about the billions, right? I'm talking about the BlackRocks of the world, right? TP Morgans, right? For them, when you look particularly at your risk and when you look at different jurisdictions, what I have seen is that some organizations do care where the crypto keys are generated because within their risk register they say, look, if this company goes bust in a different jurisdiction where I'm operating, my risk framework and my legal protections to be able to claim those assets might be different than the ones that they have, right? And I'm going to take an example in the UAE, right? So, for instance, in the UAE, there are multiple players that are coming and entering into the region, and there's only we're of course homegrown and operating in by the registered and regulated by the Abu Dhabi global market. However, we're also operating as a company there. And what I mean is that all our employees or facilities that, or we are boots on the ground. And when we compete with, let's say, other custodians, we usually go and tell them like, well, this custodian that is giving you whatever pricing, whatever feature model, they're in the UK, right? They're in Hong Kong. The challenge there is that they're, first of all, they're going to obey UK regulation. They are going to be on UK holidays, right? They're
Mhm.
going to be working on a UK time zone, right? Their risk framework, the security capabilities usually comes from their original regulator and then it's adapted to the local regulator. And what I mean by that is a UK company, that a UK based custodian that then opens an office in, let's say, the UAE, usually relies on their UK license and their UK based operations to operate in UAE, right? So this is a little bit of why, for instance, we have been successful, and now I'm speaking on behalf of Tungsten, we have been successful at closing, major organizations, local organizations, banks, financial institutions, sovereign-backed institutions as well, that they feel at comfort with our framework because we can provide in this regulatory framework. So in one sense, it's not really the cryptographic key. As you mentioned, it's not the 32 bytes that we generate within our facilities. It's all the compliance framework that it's supervised by a regulatory authority that ensures that the key that is generated within our offices, within region, matches what the client needs. But you're right. I mean, at the end of the day, 32 bytes are 32 bytes, no matter where you generate it, right?
Muted myself. I would say so Phil and I and our organization as a whole have been doing this big deep dive into the various service providers in the space, just a massive market map. And one of the hardest things for us is, let's say you've got these high level categories of custodian, you got prime brokers, you've got exchanges. But those buckets really don't satisfy any sort of actual grouping because your custodians, depending on where they are, they're providing a completely different service. Same with prime brokers. It could be like
Right.
not even like some overlap on product offerings, but it's a completely different suite. And for exchanges, it's a little easier, but even for some exchanges, it's different. And so when it comes to custody specifically, having that variance across a jurisdiction or just what the actual custody service is and what's the customer they're trying to satisfy. With you guys, obviously, I mean, the goal I assume for custody providers, you want a bunch of really big organizations to have you manage their assets or protect their assets. You have other folks that are trying to aim for retail, and it's like I said, just trying to bucket those, and then trying to figure out also, like, just in our minds, like the long-term path of the industry. Like, is there going to be consolidation? Is it always going to be this fragmented where you have, as Phil mentioned, tons of NPC providers?
Yeah.
You know, is that sustainable? They're not all doing the exact same thing, but they're all doing something very similar on that regard. And then it comes down to, your means of access, like their apps is their main differentiator. But there's only so many ways you control that. And then when it comes to integrating with external solutions, like if you're wanting to actually have payments or something like through that, like your actual
Right.
payment provider, your POS system at the end, they're not going to want to integrate with everybody. So I guess it kind of comes down to who's the most friendly to these integrations. But it's which I don't know if that's the path Tungsten would go. It seems like that's more of
Right.
just like safe harboring, large amounts of wealth, not necessarily, managing more of like the checking account or the savings account and investment side, not necessarily the checking account with like, frequent transactions.
Yes, I can comment on Tungsten's goal and ambition, right? And I think you are on the dot on regarding the sort of clients and the sort of projects that we are trying to serve. Definitely, institutions are on our large scope because we have identified institutions care a lot about governance, they care a lot about insurance, they care a lot about security. A lot of these non-functional features, so to speak, that at the end of the day make sure that exposure to digital assets, which remember that outside of the crypto world, a lot of people are still very hesitant on. They say, well, at least if I'm exposed, which it could be even stable coins, right? For a lot of people, they're like, well, I'm exposed to stable coins. They're like, hey, are you?
Right.
But even for a lot of people, that's still it's very daunting, right? So a lot of these non-functional features are kind of like the cornerstone of our services, and we have been successful a lot with local players, and as mentioned, international players that want to do distribute risk from their local players, right? So, for instance, if you are managing a large position, or you have to take care of treasury, maybe you want to distribute 10%, 50% of your treasury with us because you don't want to expose all your operational risk against one or two custodians, right? So that's one alternative. At the same time, and I think this comes depending on the use case, we are expanding on the functional things that make our services more appealing to, for instance, exchanges or asset managers, right? One of those is this off exchange custody capabilities. One of the most common frameworks that you can see that custodians, or that it fits within the custodian served rule, is tripartite wallet agreements, right? So we have in the traditional world, I guess in not only the TradFi but in crypto as well. When you think about it, that you you send X amount of money, you're expecting that amount of money back. In a centralized exchange world, it's a little bit crazy. I think as of today, a lot of people are like, well, I hope I get my money back. Like, I hope when I actually buy from this order book, whatever they're telling me that I'm getting, I'm actually getting, right? And whenever you increase the value of those transactions, the risk that you are taking increases, and as a result, people are looking for something that is not only a bilateral trade, right? And that's where a tripartite welding agreement goes, right? Which says like, well, party A wants to send X amount of money to the counterparty. Rather than send it directly, they put it with us. We take the amount of asset that was promised, and so to speak, by the counterparty, and then we swap that to make sure that no counterpart, no party needs to be trusted within this transaction, right? A little bit of an escrow setup. This sort of the functionality that Tungsten is also provided for some of our clients that we haven't necessarily been very public, but we already allowed to provide some of our organizations on that end. Now, regarding the fragmentation, and I think what I believe that will happen, a lot of people are really going for the integration play, right? So when I see more and more of these MPC solutions you mentioned, some of they say like, look, I'm gonna give you the bare bones solution and you build your company on top of us. I think there's a couple companies doing there. And other companies says like, look, I'm giving you the whole shebang. You have your integration with DeFi. You can deploy smart contracts. Let's do staking. Let's do risk staking. All those things come out of the box, so you don't have to build them themselves. And that's another option, right? And I think depending on your business needs and depending where you're sitting, as you mentioned, the payment operator is a good example. You might want something that it's fully operated or something really bare bones. I think and this is gonna happen. This is gonna happen for a little bit of time, because as the industry is maturing and institutional players are entering and engaging more and more, what it's happening is that they say, well, I can pay this provider that, this OTC broker that, does all the liquidity management and trading capabilities, or can do it myself. And then I take on that revenue. And then again, they say, well, and if I want to do that, I need a wallet provider, right? And, I can pay this wallet provider this license fee that charges me for X amount of money, or I can do it myself.
Mm-hmm.
And it goes and so on and so forth.
Yeah, that last one is something that I've been thinking about, where it seems like there's going to definitely be a portion of the industry where trading services end up being captured by custodians, just because it's like if the custodian has some kind of like this, like a regulated framework or something like this that they're sitting on top of, and then they can sort of like plug the trading services into the custodian, and then they're sort of like wrapping up all those trading services in this like regulated wrapper, like whatever that ends up actually meaning. And I guess this depends also on like how regulators end up getting their heads around these technologies and like what all this stuff means, then I think we would see, probably especially in the US, honestly, that just based on what we've seen so far with like the SPBD stuff that we mentioned,
Right.
that it's like the PBs end up being like custodians. That kind of wouldn't surprise me.
Yeah, it makes sense from an operational capacity. I think the problem though is that you have then conflicted interests, right? So I think that's what I mean about Tungsten being an unconflicted custodian, right? If I were, and it could be possible, right? Tomorrow, it is not a challenge. If you think about it, what it takes to do, let's say, trading through multiple venues and finding the liquidity and market making, it's not as hard for a custodian or let's say a broker to do a custody solution and so on and so forth. The problem is the conflict of interest. Like you are being pulled in different direction. In one side, the custody business is safekeeping assets, and in the other side, the trading business is volume, it's volatility, right? And you have this different interests. And I think, and maybe going back to the previous point that I mentioned, is like when you look at a custodian, I do think it's important to identify whether they are also offering themselves the trading desk that you can use, and maybe that it's also appealing for you as you're looking for a one-stop shop, or they're integrating with a third party. And if they're integrating with a third party, they probably some agreement in some way or form, but they are probably just pushing that business to them, and they are just obeying a mandate based on your request. if they have their own trading desk, then you know that their incentives are conflicted, right? They might be even give you very tempting custody solutions. However, and you know they have the capabilities. However, they you know that their money is going to come from trading those assets. You know that that's where it's going to be. That's where their business is going to come. And then you just need to be mindful about the amount of money you're going to pay, because you may be better off going to a particular custodian that has integrations with multiple, trading desks or prime brokers or whatever, and or in comparison going with a one-stop shop that you will get everything, but you very likely going to pay a premium for that.
Yeah, totally. I mean, and navigating the conflicts of interest. I mean, that's classic problem with finance. Like you just
Yes.
got to figure that out, and it's not always easy. And hopefully that conflict of interest just isn't something that you find out about too late. I think that's the biggest risk. I'd like to get your thoughts though, Jose. When I'm thinking about the world of custodians, what I see is that, as we've already said so many times, it's like it still is, like, it's like there's all these particular implementations, and they're kind of like coalescing into something, where there's like some structures that are starting to sort of like, okay, I can see like this is, here's a category of custodian, here's a category of custodian. But when I'm thinking about navigating all the providers, I've had to think about like, okay, what is a generalized framework I can use to think about evaluating custody providers that captures not just the like say a qualified custodian, but also captures, let's say, like a tech provider, because the
Yes.
reality of this market is right now that it can still make sense for a lot of users to just say, okay, here's all the people that deal with like managing a private key, and they have all these different
Yes.
implementations. I need some way to think about how to approach these. So here's my generalized framework, and it's actually like hearing you walk through the means of access. And then what was the next part that you mentioned?
The root of trust, where the keys are
The
generated.
in the root of trust. It's pretty similar, the way I think about it, but it's like I think of like three parts. There's first is just key generation. What the heck goes on to generate that key, whatever that might be.
Yes.
There's different methods, and the second part is going to be policy management. So like, what is the
Yes.
policy engine that exists there, and like, what the heck does that mean? Like, how is it actually making sure policies work, and that kind of thing. And then three is probably like the most like simple of the three parts, which is key, which is actually signing messages. And like, what does, once, okay, so it's like once that message is pushed through the policy management and then something is signed, like what do the controls look like to get that message on chain, and whatever that might be, whatever goes into signing the message. That's my generalized framework. And then it's just sort of like, okay, here's how each of these providers are handling this issue. But I mean, then of course you have the ancillary tack-ons, insurance, maybe trading services. Maybe you've got maybe they bake in disaster recovery into the solution.
Yeah.
And you don't have to go find that with a third-party provider. But yeah, what do you think of that framework?
Yes. So I'm very happy, Phil, because I think there is a phrase that says, brilliant people think alike, but also I think fools rarely differ, right? So, you remember that I mentioned that, there's 3 points and three identifiable things that I think, right? Means of access was the first thing, root of trust was the second thing, and the third part is governance, right? And this is exactly what you mentioned regarding policies and engine, right? And I completely agree with it. I think um, these 3 points, and when you look at every single solution in the market, when you ask okay, how are you doing these 3 points? You probably are covering 90% of the questions, and you need to understand what this solution gives you, right? So let's take a custodian. A custodian usually gives you it has governance internally and externally. And what I mean by that is you need to ask, well, how do you book your assets, right? And most custodians will tell you like we use, a segregation of duties. We have 4 eyes principle to do these kind of things. And then at the same time, if they are a mature solution, they themselves are going to give you a way to do your own governance, right? That might not necessarily be the case for, let's say, a wallet provider. A wallet provider internally very likely has nothing, has no policy engine, it has nothing. It just gives you an API. It will just give you an exposure to maybe an HSM or some MPC based policy engine. However, externally might give you some of those tools, right? So, and as I mentioned, I think some of the most mature solutions and wallet providers out there, they give you this sort of like policies, permissions, transaction engine, things like that, that allow you to do that. But very seldom they themselves have an internal governance that they expose you somewhere for. This is more like a custodian things. If you look again for the root of trust, the root of trust as well, you have wallet providers that say, hey, we generate everything ourselves and we give you all the capabilities to generate it on premise, right? And a lot of these hardware-based solutions, they say, we'll give you the tools that you generated everything. We don't touch anything, just a license fee and all that stuff. And then you have MPC solutions, but they say, well, we do some sort of handshaking where we keep something, you keep one thing, you do backup and stuff, and then we give you the whole thing. Custodians, they always generate the whole thing, right? So again, it goes with the whole full root of access. I need to have all, and particularly qualified custodians.
When you're saying custodian there, you mean like the qualified custodian moniker?
Correct, the qualified custodian. Yeah, exactly. And then about going back to the means of access, I think this is where things get very murky. This is the means of access is the part where I think most organizations, most tech providers and custodians are conflating, because it almost looks the same depending to who you ask, right? So I briefly mentioned, some tech providers going to give you a wallet. Let's talk about, like, let's say BitGo, right? So BitGo, major organization, they have both a custody solution and a tech provider solution, right? And the way you interface with each of these might be very different, but at the same time, you can interface with both through an API, right? So the means of access are almost the same, right? However, what it makes the difference and what makes kind of like BitGo custodian differentiate from BitGo tech provider, it's what it's underneath, right? And you can also very easily differentiate based on the SLA, right? So for instance, a tech provider solution will have 99.5 SLA, immediate response on your transactions, whereas a custodian will tell you like, well, I actually have people behind booking assets and I have actually warm wallets, cold wallets. I'll give you 72 hours, 48 hours, 8 hours, 4 hours SLA, right? So that's what I mean about this. This framework is fantastic, Phil. I think that's where when people approach and engage and say, well, where are your keys? How are you generating them? How are you giving me access to those things? And, the sort of kind of like authentication against those keys, and the governance or for the most tech perspective, the authorization part of things, right? So you have authentication, authorization, and of course the underlying cryptographic primitives. And for sure, all these ancillary services are always nice on the same way that integrations are.
Definitely. And hearing you say that makes me realize I think I need to more explicitly in this framework wrap up another concept, which is just storage, right? Which is what you call like capturing sort of like a little more explicitly the means of access concept that you're using. But basically in that entire, I think there's like a sense in which you have to capture that in the entire life cycle of the key, and like the entire life cycle, right? Like what that storage looks like, and then and then how that means of access, those little tunnels that's allowing that information to transition out, or allowing a raw message to transition in, perhaps to sign a message and then push out. Like what's that? Making that explicit. But yeah, that's that was really that was very useful for me. Thanks for going through that.
And Phil, if you want me just to expand on that, on this root of trust, I think there's two parts that are important that fit within that same thing. And one of thing is key management. So once, as you mentioned, once the key has been generated, where does it live and how you operate with them? Because a key on its own is pretty much useless. And the second part is how the backups of these keys are done. Because realistically speaking, only when you generate the keys, you're able to actually being able to get access to those keys.
And on the key generation side, there's one there's a point that I find like challenging to navigate. You've talked about this a little bit, like the source of randomness, this kind of thing, right? Like I mean, this actually gets like pretty technical, and the way I describe it is like sometimes you get down this rabbit hole of like sci-fi risks, where it's like it's been brought up to me before. It's like, oh well, like something you got to be aware of is that like certain Linux machines, if they're deployed on via AWS, certain Linux machines like they say they have true randomness, but in reality it's like and there's like these kind of like weird little things that exist, and I just categorize it. It's like like playfully I call it like a sci-fi risk.
I mean, the idea
Yes.
of a true random number generator is like a legitimate computer science problem that I don't know if anybody's like. It is a consensus that is kind of like a little bit cloudy on whether it's actually possible to have like a legitimately true random number generator.
And whenever you go to that rabbit hole, you're totally right, Dalton. When you go to that rabbit hole, as Phil mentioned, you get people from like climbing from all the places, like, well, actually, the only way you can do
Exactly.
that is
That's
through
exactly
quantum
what it's like.
cryptography, and you can also have. I think the industry has agreed on a couple terms: cryptographically secure random number generator. I think that's what if you for instance if you generate a browser wallet, your MetaMask, for instance, and a good example, they use cryptographically secure random number generator. So it's kind of like the terminology that a lot of, I mean, properly implemented browser wallets will rely on the web cryptographic API that is connected to the underlying random source of entropy of the machine. And that's why you can make the assessment about that, right? And I will say, depending on who you ask, you have levels of assurance. Like if you are handling probably between 6 digits, 7 digits, maybe even a cryptographically secure random number generator is good enough. However, when you're talking about institutions, when you're operating billions of assets, um, a lot of standards out there will be like, well, a cryptographically secure random number generator is not good enough to secure, for instance, against a nation state attack, right? Like the attack vector that you can have against a nation state is just so big that it will not be good enough, right? And that's why you need to go through like a true random number generator, right? And if you want to take it to the next level, right? Some people say, well, actually, quantum cryptography is going to be, a post-quantum
Right.
cryptography world. We're going to have it in the next 20, 30 years, right? So the banks that are operating that and they're using, they're not using a quantum random number generation source are not going to be good enough to secure the next trillion of assets, right? And then everybody's like, oh my God, And I really think it really based on the needs. For retail, if I'm very honest, a lot of the solutions out there, we have learned a lot about the challenges and attack vectors that some of these issues have. It really gets complicated on institutional just because of the amounts involved.
So
Go ahead, Dalton. Go ahead.
yeah, I'm trying to think through my train of thought on that one. Woke up a little earlier than normal today, but or I guess I was up later working than normal. But okay, so I guess one question would be like, how would you? So you said for retail, this is okay. So I'd be curious how you kind of like stratify client needs. I mean, I guess it depends on each person how important that crypto is to them as far as how much they need to protect it. But then I guess separate from that, when Phil talks about these like sci-fi risk, I think this quantum resistance around keys and things like that is most interesting to me because if you can once you start cracking stuff with quantum computing on different types of encryptions, like it doesn't take like maybe the key's secure, but maybe the systems protecting the keys are not as secure as the keys themselves. And then, you don't have to hack, every Bitcoin, private key. You just need to find a way to
Right.
break into the systems themselves, or, you just need to be able to crack Gmail to get access to everybody's Coinbase accounts.
Yeah, that's definitely the quantum discussion is definitely a topic. It's actually a very hot topic in Abu Dhabi because we have strong cryptographic centers, the TII being one of the most popular ones, and multiple organizations. I believe next to AI is probably one of the hot relevant topics, and similar to AI, there's a parallel to crypto just because it's using public key cryptography, which on its by definition is one of the major targets of quantum ready computers. I think here is it's really a matter of identify the actual tangible risk, right? So when you think about quantum readiness, in reality, the challenge here is that the blockchains themselves are not quantum ready. Most of the blockchains, I will say, they still rely on elliptic core based signatures, which themselves though are not quantum ready, right? So let's say, in the traditional world, if you're able to identify a transaction and drive the signature and drive the public key of the signature, then you should be able to derive the private key and then craft a new signature and then submit a transaction that drains all that money. That in a quantum ready world, that will be possible in theory. And blockchains that do not adapt to that, it's going to be a challenge. Now, whether that is an actual issue, I will say probably unlikely not. And it is very likely within the next 5 to 10 years, we're going to see that the entire blockchain and crypto industry adapt to that, because we still understand that the risk for quantum readiness is still relatively low. The problem belongs, and this is the problem happens is when you rely on non-quantum ready capabilities for data at rest. So the challenge is if let's say a national state is able in some way or form acquire some of cryptographic material that was encrypted in a way that is not ready for quantum cryptography, for a post-quantum cryptography computer, then you will not be able to then, the nation state can wait for 10 years for that asset to be attacked in some way or form whenever they get access to it.
Yeah, that sounds like a big business opportunity in the next 5 to 10 years when that transition needs to take place.
Yes.
Yeah.
I mean, and maybe I'll do a little advertise on my end, right? Like Tungsten is probably among the very first custodians that will take quantum readiness in the mist, and we are probably from in the incoming weeks also on something we will be able to share and showcase the sort of technology we are building to be able to provide quantum cryptography ready wallets, or post quantum cryptography ready to be more accurate wallets for some of our largest organizations, right? At the end of the day, the benefit of Tungsten being based in the Middle East is that we want to be kind of the corner store for multiple solutions in the entire region. And when you need to take care of, let's say, the digital asset position of a country or of, a major organization that has ties with the government, you need to take in consideration these sort of topics for the next 5, 10, 20, 30 years.
Yeah, well, that's really cool. I'm looking forward to seeing that, seeing what you guys come out with. So I have a question for you when it comes to this like first step. What I sort of like call the sci-fi risks. You know, the essentially the conclusion that I've come to is that like there at that step of key generation, you kind of require just like to feel truly content, that it's that process. Because I mean, if that process isn't safe, then you're screwed. That's the starting
Yes.
point. So the conclusion that I've come to is that you kind of have to rely on like a specialist, which these people exist now, like a specialist third party, like cryptographer, cryptography expert groups to step in and evaluate that process and
Right.
give like a third party neutral opinion. Does this make sense or not? That's like a thing that has existed for a while, and those guys exist. I kind of don't really see a way around that, honestly, and which
Yes.
which I think can be a challenge for perhaps like a lot of folks in this, and maybe not everybody, but maybe some of like the startups, because I mean that's not cheap to have those people step in and perform that kind of analysis.
Oh, for sure. For sure. I mean, one of the most brilliant, and I comment on that on a multiple basis, which is one of the most exciting things is nano ledger devices that are, for instance, there are retail base that actually generate through random number generation capabilities, right? So some of those things are actually extremely interesting on the retail world. that you're actually able to buy a retail-based device for only $500 that actually has been audited by multiple third parties, cryptographers, teams, that you know that is generated, right? And that's why I think that the value of a lot of these Trezor Ledger wallets come from, which is they package this amazing cryptographic product in a retail device that you know you can trust. And I think that's the success, for instance, of Ledger and Trezor on some of these companies. Whereas, for instance, in other solutions that are baked in cryptography that they tell you I'm going to do X, Y, Z, you need to ask, well, who audited you, or like where in cryptography we say never use your own cryptography, because in reality you are actually unless you're a cryptographer, but at that point you need to get audited, peer reviewed, academic background, etc., etc.
I mean, even on like the MPC implementations, like there's several open source MPC libraries available now, and I know that there are folks who rely on those libraries for their
Yes.
businesses, and like which it's like then there's the question of like which of these libraries are um, okay. I mean, that's
Yeah.
really the question.
I mean, MPC is a great example of that, and a great target of that. And that's what I think some organizations still have some reserves against MPC. Just last year alone, right? They have a major attacks against two surface attacks against MPC solutions. Two major MPC libraries were had been identified. Alpha Race was the name of one vulnerability. And if you implemented that, right, and you had no idea, or you have no awareness of that being happening, then you have no way to protect that. And the problem, and Phil, you and I, we had these discussions outside of this chat, which is the commoditization of this sort of libraries and capabilities make it that anybody, and I know people that a two-man studio that had built an MPC wallet, and you go to the website and you think it looks like it is amazing MPC solution, and behind the website there's actually no cryptographer. They just grab an open source library, implemented the basic interfaces, and they just launch it, right? And to your point, if you don't have someone that does enough due diligence that verifies, okay, who is this people, who are the underlying companies, what is the background, and that is sort of opaque, you might actually pose in a major risk, right? The alpha rise vulnerability that affected two of the major MPC libraries. If you are not a cryptographer, you're not involved in that capabilities, you have no way to identify that being a challenge, or no easy way to actually upgrade or verify or check your attack vectors. And that's a real risk, and that can put real money, people can lose real money.
So I guess just to be clear, at Tungsten, or what kind of like key generation are you guys using? Is it like an MPC under the hood or something else?
Yes, thanks for asking. We do both. So we do both. We use a hardware security module through a Thales HSM machine. We're do it through random number generation, and that is just pretty much we also have we follow what it's called by the capital market standard by a Swiss association, which issued a digital custody asset standard through a offline key generation ceremony. So we go outside in an observe a ceremony to be able to generate private keys that are being supervised and managed through unconnected devices, so not disconnected, but actually unconnected devices. And then through that sort of capabilities, we generate entropy to then put them into the key management solution with an HSM. Right, so this will say that it's kind of like our bread and butter. And then we had then very recently implemented an MPC solution that we will go live in the incoming weeks. We leverage, and to your point, in regards to the cryptographers, we leverage the expertise of some of the most talented cryptographers in the industry, particularly the defense team, or as some people call it, the FNS. We have been working, and I know their team for almost years now. I've been following their track record, and we implemented some of their solutions in house, and that allowed us to have the comfort that we understand. We're not only using an MPC solution that is out of the shelf, but we actually analyze it, do extensive due diligence on their solution, and we implemented that on premise. So even though we have, it's an MPC solution, which by its definition has multi signers and multi moving parts that co-sign a transaction. We own in multiple ways or forms all these shares. We distribute the risk at the end of the day. MPC is based to make sure that there's some risk segregation, and we ensure that there is some risk capabilities. But that allows us to have both an HSM-based solution that fits some particular use cases and an MPC solution that fits some use cases. The MPC one, for instance, and this is something that we will push later, once we have everything implemented to be able to distribute shares, which is the underlying crypto primitive that it's used to cosign. We can then give a share, for instance, to a client, right? And then they know that oh, I am participating into the quorum of the signature. So the means of access, and if we go back to the terminology, the means of access is not something that is just very abstract, but it has a cryptographic provenance, right? And that's very strong. When you're able to cosign with keys, it's very strong. Yes.
And when you distribute that share to the client, are you guys generating all those shares like within your environment, and then you're taking one of those generated shares and providing it to them, or is the client participating in that share generation themselves, so you guys don't hold that particular share?
Both could be possible,
Cool.
right? So that's a good point, right? Both could be possible, right? And I think here is that's what I mentioned about leveraging some of the technology. This is not something we are implemented ourselves from scratch. It's an extensive cryptographic task, a daunting task, if I may say, if you don't do properly. Again, you have all the issues you had previously with all the projects, and then of course we are able to then distribute it as needed and share it as needed. So yeah.
Yeah, that I'm glad you guys are doing that, because I've always thought, like, this whole time I've thought myself, it's like, well, if we have this technology where we can distribute the authority like that, I mean, that does like technically increase security, at least in terms of like day-to-day operations, let's say. Like if you have authority that sort of is like broken apart in different organizations, because it is true that they're like, just look at banks. Like banks are, it's like we use the term bank grade security, but it does happen that a bank gets data leaked. Like this is just the world that we live in. And so it's like, if we have
Yes.
tech where we can distribute that authority, it's like, I mean, it's like, it's an exponential function in terms of security, in my opinion. So it's like, why not do it? So I think that's
Yeah.
awesome. And that's really, and I really, I like the defense team a lot. So that's really cool to hear.
Yes.
And there was something else I was going to ask. It'll come back to me in a second. Dalton, do you have a question to fill the void while I'm thinking of my what I
I
was
do
thinking?
not. No, Jose has done an awesome job of, well, multiple things. One thing that you did probably about 20 minutes ago that I was going to compliment you on, but you had this great train of thought going. Mid sentence, mid train of thought, you pause your mic, cough, unpause, continue your train of thought. And if nobody was watching the video, they would have no idea it happened. And then I've also seen you. It sounds like you've got a happy family running around. It's not
Thank you,
distracting at
Dalton.
all. But I've just noticed you, like you said, mid sentence, pausing, telling your family you love them. I'm sure, unpausing or unmuting, and then continuing your train of thought. So just that has been very impressive. Just viewing you with your mute control has been pretty awesome.
Uh, I appreciated the kind words, Dalton.
Yeah.
I always, I have a lovely, beautiful two daughters, and
Yes.
they roam here and there. But
Yes.
my family is very kind. And to that point, right? The fact and the flexibility we have in nowadays world, I think it should not be missed in the crypto world, right? The fact
Right.
that we can deploy financial systems, and we can run it. I mean, Tungsten, it's a distributed company. We have our base and headquarters in Abu Dhabi, but we have engineers across the world. And the fact that that doesn't stop us to deliver one of the best solutions in the market is just a statement of the modern the advancements we have done in the modern world, both from working remotely and in the crypto industry, which
Yeah.
again, with Phil's point, we should be able to distribute it as well. And one last point there, Phil, and just to pick on that, I think regulators and maybe tying back up to the initial topic about how brokers might be required to have these full access controls and how these things, I still think one of the most daunting challenges on distribution of all this wallet management is compliant, right? The only reason why, I cannot hand over, let's say, I have the technical capabilities through MPC and through the solution the defense team has provided to give every single of my clients a wallet that they can only move if they co-sign with like their passkey or what have you. The only reason why, as a custodian, we cannot do something like that is because as a regulated custodian, I need to make sure there are anti-money laundering controls, counter-financial terrorism controls, KYC capabilities to identify for PEP or sanctioned individuals. So all these things I think are going to get better, and we will eventually identify a truly decentralized wallet management and cryptographic ecosystem. Right now, the best we can do is distribute it. If I'm very honest, at the wallet level, we distribute the cryptographic shares. But once we can really decentralize the responsibilities, once we can find this all these responsibilities, we really share them across the people that we engage in the crypto world, I think we will be able to just really have no reliable no central point of failure for our custodian needs.
Yeah, I will actually say that when I first got involved in Ethereum smart contracts, I don't know, 2016 or so, the biggest draw to me, similar to what you were talking around, was as a CTO having the idea that all my infrastructure was shared across thousands of nodes, and I was like, oh, I could just, instead of deploying this app code and having to stay up all night worrying if my AWS servers were running, I deploy as a smart
Yes.
contract and I let these 3,200 nerds around the world running these nodes, like that's their job now to make sure that my stuff's running.
Yeah.
And that provided me a lot of flexibility, freedom of mind. But at the time, it's too expensive to actually run any legitimate software. Too expensive for a client or a consumer to use your tools with the way gas fees were set up. But
Yeah.
there are a lot of opportunities for kind of flexibility from the new systems being developed.
And I think the a lot of blockchain projects are picking that up. I think that's where you are seeing, app chains
Mhm.
and, all these other solutions that identify that, maybe you cannot decentralize everything out of your whole business. However, if you decentralize, a few parts, then you are able to actually take advantage of those benefits, right? I mean, I'll give you an example, right? Running a custodian, you always have to do this sort of like third risk party assessments, right? Is you need to do these vendor risks solutions. You need to identify how do they match within your risk registrar, and so on and so forth, right? So the challenge here is, well, wouldn't it make sense way more to just put of those some of those parts into a fully decentralized solution? And you're totally right, right? Trusting, putting that into a decentralized solution makes things way better. I will love, right? I'll give you an example. Let's say a CMDB, your inventory system, where all our items and all our inventory for the company has been managed. That will be amazing to have on a decentralized solution, right? And I don't need to run everything, but upgrading some of our solutions, and I think there are more and more use cases, tangible use cases that the blockchain industry will find that are not only meme coins and
Right.
exposing some asset reserves to one particular token.
We hope so. We hope
I
so.
hope so. Yeah, that's yeah. So okay, question I have: disaster recovery. That step. How do you think about disaster recovery? I guess in the context of the qualified custody setup, we can start there.
Yes. So, Phil, I think out of the whole custody frameworks I mentioned, right, there's three main points, and one of the points that are not necessary right away from that is exactly what you just described, which is disaster recovery, right? And I think the only reason why I think it doesn't fall right away within a traditional custody model is because it's only been recently been driven up, so to speak, for a lot of crypto industry. Even though, if I'm very honest, the standards around business continuity and, for instance, disaster recovery has been around for, 20, 30 years or so. From a custodian perspective, what I must say is, disaster recovery is both a strategy, right? It is a process that you need to engage with, but it's also a problem in terms of how do you approach crypto asset management. And what I mean by that is in a lot of traditional disaster recovery models, you need to go into what you will understand as your business continuity plan, right? So disaster recovery focuses on how, given a particular natural disaster, you are able to obviously follow some sort of strategies, procedures, and processes to be or operational again.
If we
And
could also, would it be fair to include in that, Jose, like just some kind of like human error? Somebody accidentally deletes a database entry or something like this, and
right,
it's like, oh, I don't have my key share or like whatever the heck I need to access
right.
privileges.
I think on that end, I will say this is the second part about asset management. On the custodian world, usually disaster recovery, although not all the time, but usually focuses a lot on the private keys because it's kind of like, the last part where, most people lose money. But you are totally right. Is well, what happens when if you have a human error and you transfer money out to the wrong address, right? That doesn't necessarily fit on the same concept of disaster recovery from kind of like its
I
core
agree. I
definition
agree. Yeah.
from the end. However, I do think within the if you think about to a crypto custodian, it could be as bad as losing the key. Like losing the assets is probably akin to losing the key, right? It's just that the terminology is very, very specific, and when you go again down the rabbit hole of what financial institutions or other businesses have been building for the last 30, 40 years, they are very particular process about, okay, how do we recover in case of a major flood, in case of, and I'll give you some silly examples that some people don't think about it, but let's say you're a traditional custodian, they lose electricity, right? Like the pandemic, right? So when we saw the COVID pandemic, some organizations were affected in one way or form to operate what you will think it will be a traditional 24/7 crypto business, right? And this is because at the end of the day, you have these underlying operations that need to be fulfilled by multiple moving parts. And if you have people that cannot go to a location, that maybe there are blockage because some jurisdictions are doing roadblocks or they close a couple of things. This is where I think it goes beyond it goes well within the disaster recovery framework. Now, what I think is important, and this is what I think is more relevant to the crypto world and has it's outside, not outside, but it's not as relevant, but it's still within the context of what we understand crypto understand as disaster recovery, is backup recovery, right? So you see major organizations, I think probably one of the leaders had been coin covered that they said like, well, given something happens, we can actually back up some of your keys and we can provide you the some availability if it is needed. We might give you some redundancy of your backups, right? So I think within the crypto world, there are some mechanisms that focus on those things, and there are even some new non-incumbent players, right? I mean, Station 70 very recently by Adam Healy's team, and they have very talented people building some backup recovery that it's outside of the traditional backup recovery that they do attestations of those recovery. You have Circuit as well that they are doing. They approach recovery from a more keyless capability, right? And they go and say, well, we don't care that much about the key. We just care about the assets, and we are able to provide you recovery of the assets. So I think the industry is definitely opening up to what it means to take care of or recover from a particular disaster within the crypto industry, and they look at different angles. And as you mentioned, some solutions are baking those up, and I know by a fact that some custodians are hiring and acquiring more and more of the solutions to enhance their asset value proposition.
Yeah, Nimian as well. I think is a name that I'd mentioned in that bucket of those solutions. And yeah, and I guess I've always thought of what you just classified as sort of like the distinction between disaster recovery and backup recovery. I've kind of thought of them like kind of in the same bucket usually, because it's like it's kind of like regardless of what the situation is that leads to your loss of information, it's whether something an EMP blows up or whether it's like
Right.
fat finger event, which is far more likely, knock on wood, hopefully.
Yeah.
Right. um
Yeah.
I've kind of thought of them under like a similar kind of bucket. But I guess one more time, just for my sake, like how would you like
Mhm.
distinguish the difference there once again between the disaster recovery and the backup recovery, and then what that actually ends up meaning from a like operational perspective?
Yes. So that's a good example, right? And if you identify, if you will want to say, how do you measure, for instance, a custodian tech provider? I think there's two parts, right? So usually, a disaster recovery plan, for instance, when you ask or you identify a custodian, what is their disaster recovery plan? You're talking about it like, well, what happens if your infrastructure goes down? What happens if you, as a business, something happens to you? Right, and this is an important. Some major organizations will tell you, and and a good benchmark, for instance, I'll tell you a good benchmark is that, hey, these are our scenarios that we have recovered. These are the test plans. Sometimes they don't share the like the actual plan, but they say, but these are the results. That they say, like, look, we conducted a test plan against this particular scenario, and we these are the results we identified, these are the chance we identify, and we did this better, and we're gonna do this better, right? This is kind of like your A, maybe not A plus, but at least kind of like a good organization that understands that there are multiple things, that there's a risk officer on top of all these things, and you have identified the things that can go wrong with the organization. When you talk about the backup recovery, it's very well within the asset, the crypto asset, that says, like, well, what happens with an organization if you're unable to procure within your key management solution, within your key ceremony, to get the underlying cryptographic primitives or the root of trust to your disposal, right? And this usually happens on a key management level in the more operational framework that says, okay, let's say, and this is the example that I gave, let's say you, as an organization, as a custodian, your main key wallet provider goes down, right? Like, how do you operate? Like, how fast can you operate, and how fast are you able to retrieve the backups? If you have in with capacity, are they geographically distributed? Are they redundant? Are they, how do you're able to engage on those, right? And in a custodial level, it's easy to say, well, what happens if something goes wrong to you? And the second part is, what happens if it goes wrong to your vendor, your provider, to your tech, to your solution? And on a tech provider basis, in a tech level as well, it's like, what are you giving your client, right? So more often than not, the tech provider solution, when they look at the backup recovery dimension, they say, well, we give our clients a way to access their backups, right? And this goes from self-custody, right? The nano ledger, they say, we'll give you the mnemonic phrase, and our backup recovery is literally this piece of paper where you need to write these 12 words, and that's it. In major player, they say, well, we're actually going to export encrypted extended private key of all your assets, and we're going to give you kind of like a backup generation ceremony where you get all those assets given to you, and you make sure that if something happens to us, you can operate on that. And I think all those dimensions of the extent of those backups are provided, right? But it really differs. I think another good benchmark on those for all these players are SOC 2 Type 2 controlled SOC 2 Type 2 reports are good. I usually should have controls describing both the backup generation among these organizations. So at the end of the day, a SOC 2 Type 2 has a set of controls defined by the organization itself. Um, but the report usually it should extend, or it should define at least a couple things around backup generation and recover, for sure.
Yeah, and with the disaster recovery, there's like this very challenging step, like I say, this is like having from the perspective of like building a trading operation ourselves and having to think about like all of these, aspects. The disaster recovery well, I guess what I call disaster backup recovery. Let's use that term. The backup recovery, um, like in the context of like whatever custody it is that you're consuming, uh, it's actually like a multiplier of complexity for the fund manager in doing that, because not only do you have to think about like how you're going to consume that disaster recovery just generally, you also have to think about like how explicitly does that disaster recovery interact with the particular custodian or custody tech provider that I'm using as well, right? Because there's all these different implementations. Um, and I mean, that's just something that we've like experienced ourselves, is like sort of like the explosion of, um, yeah, just complexity, like all the moving parts, and then like how that changes things down the line uh, with your operation and and your business.
I mean, you're totally right, and I think what is scary, and I'm not trying to sell a custodial solution. I'm of course definitely running one, but the problem and about all these topics that we have discussed: root of trust, backup, key management, transaction, means of access, governance, disaster recovery, is that messing with one of them or failing to excel at one of them can literally mean just losing all your money. Right? I'll give you an example. Uh, an in-house mishandled backup recovery mechanism ignores your root of trust, your key management, your governance, your policy. Let's say you say, okay, I know how to do a backup generation ceremony myself. I do my own stuff. I trust, my own team to do this stuff. Suddenly this team, have an internal collusion. That's it. All your money went out. Has Just because you generated the private keys, even if those keys were loaded into an HSM, even if you have an amazing segregation policies, governance, and they were secure in, the most quantum post quantum cryptography ready, if those keys they were just stored in a plain paper and then store and the guy that stored took a pic of them, memorized them, that's it, game over, right? It's the same thing with like the governance and the policies, right? You do everything, you do an amazing job, you have a stuff in an HSM NPC distributed stuff, and the joke that I run is like Mike from the second floor, like, and they managed to drain all the money because they managed to approve their own transaction, just because the policies were put in such a poor play, in such a poor way, that they can transfer everything out with no further controls. So that is the part that I think is very daunting about all these conversations. Done poorly, any of those sort of like 7 points that I've just mentioned can mean for your traditional organization, oh, suddenly I have no money, right? Which is not very true in the traditional finance world. Like,
Right.
Yes.
your chances of your bank wiring out all your savings to the Nigerian prince is very low, because they themselves, the Swift network, the way they work, their operation, a lot of things are going to stop that transaction from happening, right?
Right.
Here, and the good thing is at least the Web3 world is maturing, so you'll see all these ancillary services that are doing, Web3 firewalls or things like that. But yeah,
Yeah.
that's the state of affair.
Yeah, and that is why I do like going back to, you mentioned your partnership with Defense and like opening up the potential for users to like have a key share themselves, where it's like they have it and you guys as the custodian don't have it. I think that is like really a nice path and option to go down, just because, again, going back to what I said earlier, bank grade security term we use, but banks have definitely had data breaches, and the way crypto works,
Right.
it's like if that information is exposed, it just has to get exposed for an instant. And there's some like
Yeah.
crazy black hat somewhere who's got some web crawler just ready to like find what looks like some
Yeah.
sort of like private key information, and then it's over,
Yeah.
like that, right?
I, I agree. I think my only take there is that, and I see this challenge in terms of building a solution. Let me rephrase it. One of the challenges the Web3 industry or the crypto industry has by handing over crypto control to everybody and operational management and autonomy and self custody is that they also had made people believe they can do that. And I think there is a balance between, I never want to think um, that people are not able. Like, I'm a strong believer of self custody. I do think the level of capabilities and know-how needed to do proper self custody is extremely high, but I do think it's achievable. I do think it's a race of education. Eventually, I think as people grow up, it's going to be definitely easier. The challenge here will be on that has definitely created some overconfidence on some people, and that's how you get some of the even crypto OGs, major crypto ball people getting hacked, right? And I have people came to me or to us as an organization and say like, well, I am managing my own assets. Why should I, why would I trust you? And I'm like, how do you trust yourself? Like, I don't trust myself, with like, cooking my own dinner sometimes. Like,
Right.
it's like, it's crazy how just because you can doesn't mean you should. And I think this is an important lesson. And I talk extensively about, I do think building the tools to allow everybody to do is amazing. It doesn't mean everybody should. And you
Right.
should really think about what sort of risk and what sort of frameworks you're doing when you're doing your own self custody for
I,
sure.
and I think the big one with, should you choose to do it yourself or should you not, is that backup recovery step, frankly, because it's like maybe you can get confidence that your policy management is set up appropriately, because you're probably going to be relying on like some third party, like you guys who would be ultimately the ones who are implementing the policy management itself, like you're controlling that piece of software, or maybe there's I know there's some like third party kind of like entities that are coming up now who like specifically just do policy management and then they plug that into your environment. But then it's like, as the user, if you're going to have that key share, let's just say you get your policy management set up right. Let's say everything is done fine, but then you can still, like you said, it's like you do something wrong with storing that
Yeah.
information, and then you're done. If it's a 2 of 2, if it's a whatever, a 3 of 3, or whatever it might be, and you're one of those two, or one of those three, and you're required, well, you're toast.
Yeah.
That's it.
The best example that I can give here is, and I mentioned, right, that I participated with another organization at some point of time where we use traditional multisig, right? And in this case, for instance, you say, well, in an on-chain multisig, you're able to actually, you have your governance, multisig, everybody manage their own keys and so on and so forth. I know, I know for a fact, and seeing that in perspective, we had a centralized point of failure by one of the founders, because if something happened to them, if the founder moved away, we just couldn't pay, we just couldn't do payroll, right? And I'm talking about like a 20 people organization in 2018. And when you think about that, if you think about the risk that, for instance, myself, I was taking as a a contractor, as a director of that organization, that I just couldn't allow this person something happen to them because we didn't do a backup recovery mechanism if he missed in some weird form. It is a little bit crazy, right? And I know for sure there's someone, at least one or two people here in this podcast, that they think, look, I have my business, we have 2 3 ledgers, something happens, and you think about it as well. If something happens to your partner, and God forbid, they're in an accident, they're unavailable, whatever, do you have the backup keys to have access to that, to that access? And if you do you really have some governance, right? So it really is a little bit of like, that is the challenge you have when you are making your own things. And it's really, even I spent 12 years in Switzerland. Switzerland was the kind of like the first crypto hubs. I saw everything. I saw from like lawyers, handling pieces of paper,
Right.
people cutting, phrases in for papers, safe vaults, storing mountains, whatever you call it, right? Still
And
a big problem.
yeah, if you have not come across an event where you've been afraid because you haven't been able to figure out how to recover your seed phrase, you have you haven't had that sheer terror of being like, "Oh my gosh, did I just lose this?"
Yeah.
You have not been in
I've
crypto long enough,
there have been multiple times where I was 3 out of 4 attempts into trying to figure out my PIN on a
Yes.
hardware wallet, and
Yes.
somehow I
One.
always get it. But but
Yeah. Well, the number five is a charm. One of the final ones regarding backups, for instance, is that backups should be testable, right? So people should have
Yes.
in a periodic amount of time that depends on everybody and on custody model, tech provider, whatever. They should be able to make sure that you can still have access to those assets, and those assets and those backups are resilient enough to withstand another amount of time.
Yeah.
So to your point, right, and Dalton, to your point, I think people, for instance, that people that store their mnemonic phrases, right, for their own wallet, in an ideal world, given a proper capabilities, they should be able, let's say, once per year, go to their place where they have those backups, load them in some secure offline way, generate a transaction like a test transaction. They take those things offline, restore the backups again, and put the backups away, and then again make sure those backups are still up and running, right? Some people put those things away, forget about it, they think they're safe, and they check back on them 3 4 years later. Their nano ledger broke, they go fetch the backup, now the paper is wet, it got humid wherever they put, you can not see all the words, go crazy, right?
Dude, yeah. I mean, if you've been involved in crypto at all since, I guess prior to like, I don't know, 20, I don't know, 20, probably like any time before then,
Yeah.
really your solution was like you had to get a hardware wallet, I guess at that time,
Yeah.
because what Fireblocks was founded, I guess they were kind of like the
2018.
2018. Okay, yeah, but it wasn't necessarily like well, it definitely wasn't a retail product, and it still isn't, right? Um, there actually are some kind of like NPC products that exist now that are like pseudo retail, I'd call them,
Right.
you know.
Yeah. Well,
Yeah,
may you shout out to one of my favorite retail wallets, Sengo Wallet, NPC-based solution. They actually distribute. They don't give you a mnemonic phrase. They're actually very against a mnemonic phrase solution. They do an NPC 2 out of 2 within them and you. And yeah,
Hmm.
they do backup recovery through your own device, cloud storage. They have an escrow setup where if they go kaput, then you're able to recover them to a third party company. So a lot of retail solutions, I think, are maturing and building all those things that we have just been discussing as well.
nice. Yeah, I think it's going to be a big step when those retail solutions make it easy to understand for the person on the other side too, because it's still pretty confusing for most
Yeah.
people to do that and to think
Right.
about that, and then you're just like, I'll just put it in Coinbase,
And
right?
and going back to it again, the model that a lot of people are not comfortable with. Like if I take Sengo, for instance, I know many people don't use them because they don't like the NPC model, right? Because they say, well, if something, I do not trust that that I'm gonna get the shares that I needed to actually operate if something happens to them. I do not trust that they might go out of business. Or one of my favorite examples, that I remember I talked with our team, which is like, if someone uses Sengo for nefarious purposes, right? I'm talking about tornado hacks, freaking North Korea agent or whatever. Their NPC model cosigns those transactions, and of course they know the address that the transactions are being cosigned, right? And I guess the challenge here is like, well, um, if they cosign or they author or they're able to cosign the transaction that comes from very nefarious purposes, are they liable in any way or form to authorize the move from assets that are obviously for, let's say, financial terrorism? And if they are not, wouldn't then that destroy the purpose to justify that they are fully non-custodial? So I think that is a double-edged sword, right? It says like, well, if they sign everything, they could be, identified as a company that is actually enabling or participate or providing infrastructure for terrorists or money laundering. But if they do not, then that sort of breaks the whole concept of their actual non-custodial solution, because they actually neglect to participate on something. And if they neglect to participate in a particular select of options, even if it's for particular select of options, they say, well, then you are at the end of the day participating whether I can move my assets or not. So it's tough. It is really tough.
Yeah, 100%, and but it's getting better, and it's getting better fast. The Jose, we've kept you here for quite a while, and I really appreciate your insights.
No worries.
Before we close out here, Dalton, did you have any questions?
No, yeah, thank you for your time and thank you for your family's patience as
Yeah.
they've been.
No worries.
You know,
Thanks to you for having me here, and appreciated insights and having a chance to do a both a shout out to Tungsten and some of the learnings that I have made along the
Y-
way. So.
Yeah, thanks for sharing. And do you have any like any final thoughts or like contact information if anyone would like to reach out?
Yes, for sure. So, as mentioned, Tungsten is available to our UAE domain, tungsten.ae. We have, a very B2B solution, so to speak. So we're also very quick available on LinkedIn as well. And I think on final thoughts and on terms of how do I do think people need to care about where their solutions are based, where their keys are generated, the sort of jurisdictions compliance framework that it's coming. I'm extremely bullish about crypto in general. I am overall happy that I think the crypto ecosystem is getting a boost based on some major events going through the world, and I think we're gonna see more and more people and institutions getting involved. I think when they do, it is important to have a reference to use some sort of framework. The more documentation, the more reference people can use to understand the solution counterpart they are engaging, the better. More information never hurts. And that's it. That's pretty much it.
Awesome. Well, thanks, Jose. If you could stick around here for 1 second, just to make sure everything gets uploaded.